Welcome to Money is Freedom, a podcast exploring how finance and freedom connect in our lives. Created from thoughtful research and narrated by Notebook LM AI, this series brings you clear, meaningful insights into finance and beyond.
Welcome to episode 52. Today we dive into AI's ongoing valuation correction, the margin trap. AI valuations are soaring at approximately 40.6 times revenue, yet margins lag 20 to 25 points below SaaS. This isn't hype. It's a structural economics problem where unsustainable growth will hit a wall.
Welcome to the Deep Dive, where we cut through the noise to deliver those critical insights you need to truly stay informed. Today, we're diving deep into a topic that's, well, it's everywhere. Artificial intelligence. Groundbreaking stuff, transformative even, but is the financial foundation actually as solid as all the hype suggests? We're looking closely at a really insightful article. It's titled, The AI Margin Trap, Why Billion-Dollar Valuations Are Built on 50-Cent Economics, by Dana the VC, published August 26, 2025. And our mission here is really to peel back the layers, get past the buzzwords and understand the actual economics driving this.
Exactly. And this article, it just nails this fundamental disconnect that's brewing under the surface. It's a huge tension point. You've got AI companies valued like pure software businesses, right? Sky-high expectations, effortless scale, huge profits. But then you look at how they actually operate, their costs, and it looks much more like manufacturing, capital intensive. It's this hidden conflict that's really critical to understand.
Okay, so you see all this money pouring in, right? The article mentions, a staggering $104 billion in venture funding just in the first half of 2025. Feels unstoppable. But are we starting to see maybe some cracks in that foundation? Is this AI gold rush heading for a bit of a reality check?
Oh, absolutely. The signs are definitely there. You're seeing AI equities drop maybe 15% in recent months. And that's bringing unprecedented scrutiny onto the business models themselves. Veteran investor David Sachs, he put it pretty bluntly. He warned about founders turning down multi-billion-dollar offers for companies that haven't even launched a product yet. He said, basically, these offers don't grow on trees. They just don't. He even mentioned Mira and Ilya, suggesting maybe they should have taken those deals.
That's quite a warning from Sachs, and it really hits that core problem he pointed out. AI companies valued like software, operating like manufacturing. So can you give us a sense of how big this disconnect really is, with some numbers? How extreme is this valuation gap?
It is astonishing, honestly. The AI premium is just off the charts. These startups are trading at, get this, 40.6 times revenue. 40.6x. Now, put that in perspective. Look at other hot sectors. Fintech, maybe 20.4x. Payments, 17.7x. PropTech, 16.3x. And traditional SaaS, the usual gold standards for software, that's baseline 8.3x. So AI at 40.6x, that's a 390% premium over SaaS. It's the most extreme valuation premium we've ever seen in tech history. Even higher than the dot-com bubble. Those multiples rarely went above maybe 20, 30x. This is something else.
Wow, 40.6x. That's hard to wrap your head around. So the market isn't just optimistic. It's basically betting that AI will be more profitable, more efficient than any other tech sector ever. That seems like an incredibly high bar, doesn't it?
It's an extraordinary bet.
Yeah.
Essentially saying AI economics will beat everything else we've ever seen in software. It's built on hope, frankly.
Right, but are they actually earning that hope? What do the real numbers, the actual profit margins, tell us about whether that assumption holds water?
Yeah, and that's where the picture gets really, really stark. The margin data directly contradicts those sky-high valuations. Investors are paying 5 times more for AI startups than SaaS, right? But look at the gross margins. Traditional SaaS averages, 77%? You've got GitLab way up at 91%, Adobe 88%, Salesforce 76%. Pretty healthy. Now look at AI. The leaders, like Anthropic, maybe 50-55%, OpenAI around 50%, Perplexity, maybe 60%. Even the best are operating 20-25 points below the SaaS average. And for others, it gets worse. StackBlitz, 40%, Lovable, 35%, Replit's down to 23%. And this isn't just, they're young, they'll scale out of it. It seems structural. It's driven by those variable inference costs. Every time someone uses the AI, it costs real money for compute.
That difference is just massive.
But couldn't you argue, people do argue these are just early days. Scaling costs, won't the margins naturally improve as these companies grow, get more efficient, maybe closer to those SaaS numbers? That's the hope, right? That's definitely what investors are banking on. But the article really pushes back on that. It argues the nature of AI inference, that cost is for every single user query, creates this ongoing high variable cost. Software usually doesn't have that. not to the same extent. SaaS is more about high upfront costs than near zero cost per user. AI flips that. So getting those margins up is a much, much tougher climb than just waiting for scale. It's not automatic.
Okay, so these thin margins, they're not just an accounting issue. They create real fragility, real operational risks. Does the article give an example of where this margin fragility really caused problems for a company?
Oh, definitely. The Cursor case study is, well, it's pretty dramatic. Cursor was an AI-powered code editor. They ran into huge trouble because essentially their flat pricing hid negative unit economics. They were losing money on heavy users. Then they switched to this opaque token-based billing, and some users suddenly got hit with bills for like $7,000 a day.
Yeah.
Huge shock. And then to make it worse, when people complained, their own AI support bots started making up fake restrictive policies. Yeah. Total mess. Result, mass customer exodus. And because Anthropic relied on partners like Cursor for distribution, it actually threatened Anthropic's revenue stream too.
Yeah.
It just shows when your margins are that thin, there's zero room for error. No buffer for mistakes or unexpected usage spikes. It's incredibly fragile.
That's a complete nightmare scenario. And it brings us back to the money, this level of capital intensity. It really makes you wonder if investors have fully grasped it. Are they funding based on this new reality or still using the old SaaS playbook? What does this margin profile mean for how much cash these companies need just to survive and grow?
It means they need a ton more capital.
Right.
Way more than a similar SaaS company. David Sachs's framework on capital efficiency really drives this home. It's eye-opening. Say you want to scale to $150 million in ARR. An 80% gross margin SaaS company. It probably hits cash flow positive, maybe even generates around $27 million by then. Now take a 50% gross margin AI company aiming for that same 150 mil ARR. It burns through an extra $80 to $100 million in capital just to get there.
80 to 100 million more.
Yeah, and if you're a 23% margin company, like Replit, you're burning over $160 million more than the SaaS company. That difference, we're talking over $130 million in additional funding needed just because of the margins. It's a fundamentally different capital game.
Goodness. With that kind of cash burn and those low margins, the path to an IPO, to actual sustainable profitability, must look incredibly steep. It's not just a long road. It sounds like climbing a cliff face.
It is incredibly steep, yeah. You know, public markets, they generally want to see, 10, 15% operating margins? So if the AI leaders are starting at 50, 60% gross margins, they need to find another 35 to 45 percentage points of operational leverage. And what that means, for listeners is they have to drastically cut their other costs, R&D, sales, admin, relative to revenue as they scale. That's tough. It implies like 3 to 5 years of absolutely perfect execution with basically no major competition popping up. That's a very big ask in this market.
Okay, so the climb is already steep. But then the article mentions this: accounting gamesmanship. What's going on there? How could that be making the picture look even rosier than it actually is?
Yeah, this is a really crucial detail. Turns out, many AI startups are not including the cost of serving their free users in their main gross margin calculations.
Really? They just leave that out?
Seems so. OpenAI reportedly does include those free tier costs. And that's part of why their reported margin is around 50%, which the article suggests is probably closer to the true economic reality. But many competitors, by excluding those costs, can show higher margins, maybe closer to 60%. It looks better on paper, right? But the article argues, look, if you factor in the compute costs for all those free users, most AI companies are probably operating closer to 40, 50% gross margins in reality. And that, given the valuations, is well into unsustainable territory.
Wow. So let me make sure I understand this for you listening. Companies might be getting valued based on numbers that don't fully capture their real costs, which makes that already steep climb to profitability even harder, pushes that need for perfect execution even further out, requires even more capital. It feels like investors might be chasing a bit of a mirage here.
That's a good way to put it. It definitely masks the true capital intensity and the underlying economic challenge.
Yeah.
Puts a massive bet on future efficiency gains that just haven't materialized yet.
Okay, so the article basically says the correction isn't on its way, it's kind of already happening. Market forces, economic reality setting in. So as things shake out, what does the article say companies need to do? What are the strategies for survival here?
Right, it lays out this survival framework, 3 main paths for it. First is margin optimization. The efficiency play. This means things like deep instance optimization, quantization, distillation, making models run leaner, faster, cheaper. Also developing custom chips like Google did with TPUs, or vertical integration, controlling more of the stack to keep costs down.
Okay, efficiency. Makes sense. What's the second path?
Second is business model evolution, the platform play. This is about shifting away from just selling compute-heavy API calls, maybe becoming more of a platform orchestrator, building marketplaces, or focusing on high-value enterprise solutions where you can charge more, create stickiness, and hopefully get better margins than just per-token billing.
So change the game you're playing. Got it. And a third.
Third is scale economics, the infrastructure play. This is for the giants, really. It involves negotiating super preferential deals with cloud providers because you're buying compute at massive scale, or even building your own proprietary infrastructure, basically getting so big that you can fundamentally change your cost structure through sheer volume and maybe justify that custom hardware investment.
Efficiency, new business models, or massive scale. Okay, so looking at those paths, it does feel like we've seen similar patterns in tech before, right? Given these strategies, who does the article suggest is actually well-positioned to navigate this, and who's really at risk in the coming shakeout? Sounds like clear winners and losers are emerging.
Absolutely. The article is pretty clear here. Positioned for success. They point to OpenAI. Why? Well, diversified revenue consumer subs, enterprise API, plus those huge Microsoft subsidies acting as a buffer and infrastructure advantage. Anthropic is also mentioned as potentially well-positioned if they maintain their focus on enterprise and strong margins, and crucially diversify away from just being an API provider. And, generally any company that has a clear, believable path to getting those gross margins above 70%.
Okay, so OpenAI, Anthropic if they execute well, and anyone with a path to high margins. Who's on the other side? Who's at risk?
At existential risk.
Yeah.
Basically, companies stuck with sub 40% margins. The article names Replit, Stacklets, Lovable as examples facing potential funding cliffs as investors get more discerning. Also, those pre-product companies still turning down huge acquisition offers Sachs's warning seems very relevant here. And really, any business that's heavily reliant on just selling API access without a clear plan for how to dramatically improve those margins, they're stuck with those manufacturing-like costs without the scale or strategy to escape.
Yeah, it really is a classic tech story playing out again, isn't it? Growth at all costs eventually runs into the wall of unit economics. What we've talked about today, these 40x revenue multiples for businesses struggling with 50% gross margins, it really does feel like one of the most concentrated, high-risk bets we've seen in venture capital history.
It truly does. Look, the AI revolution, it's real. It will transform industries, no doubt about that. That's not the debate. But the current valuation environment, it's just not sustainable based on the underlying economics we're seeing right now. So the critical question for you as an investor, for founders is, will today's high-flying AI startups with these business models and these valuations actually be the long-term winners? Or are they just paving the way, burning cash to build the infrastructure for a different set of more economically sound companies to eventually capture the real value? It's a huge question.
And that really leaves us and you with a provocative thought to chew on. Thinking about everything we've just discussed, does taking that billion-dollar offer for a pre-product company suddenly sound like maybe the smartest move some founders aren't making? What does this deep dive make you consider about where AI investment and innovation is really headed next?